Time for a quick flashback to Friday when we got that jobs report, which took Wall Street by surprise when the government reported that 467,000 jobs were added to the economy in the month of January. Expectations were much lower given the surge of Omicron cases throughout that month. But our next guest actually had a prediction that was pretty close to the real number that we got. So who better to discuss the future labor market conditions than Peter Morici, economist and University of Maryland professor of business. Professor, it's great to have you on the show today. Your guess was 250,000 payroll additions for the month. A lot of people on Wall Street had negative expectations, and the ADP print that we got earlier in the week showing a contraction of over 300,000 got a lot of people spooked. Why did you have such a positive read on the January jobs report that actually ended up being pretty close to the actual number?
I don't think that businesses want to lay people off just because there was the Omicron strain and so forth. And they've been struggling to hire people, for the last several months. So I think that hiring exercises were just continuing in the anticipation that Omicron would, peak over a period of 3 or 4 weeks. So there wasn't much let up. The other thing was there was a lot of pressure to keep things going. Now we're starting to see anecdotal reports as they come in that a lot of, for example, companies in the food industry, cereal makers, meat packers, and so forth. As folks called in sick, they relied on part-time workers. Well, if you're paying someone when they're sick, they count as an employee. And if you pay for a replacement, that counts as an employee too. Because they're basically asking, who did you pay this week, the week of the 12th?
Right. And that kind of brings up the nuances of how the survey is done. But at the same time, there are some questions about the revisions, right? Because there could be a large confidence interval issue with the numbers that we got, because 2022's January report reminded us that there's an annual benchmarking where revisions for months that were reported in the year prior could be marked up or marked low as much as 400,000 jobs. In some cases. Do you think that might have played a factor into what we saw in January? Should we expect to see that number get revised down based off of the surprise that we got?
No, I don't think so. I don't think there's a reason to believe it would go one way or the other. One of the problems we're dealing with is that the normal seasonal adjustment figures that we use, reflecting patterns of layoffs in January and retail establishments, as they wind down from holiday shopping and then the returns week, the first week in January, don't work as well as they used to because we're in this very unsettled environment. But by and large, numbers tend to get revised up, not down. The report is based on a preliminary survey for the month of the 12th. That's a survey and it's limited data, just like a poll for who are we going to vote for president. At the end of the year, what they do is compare that to state governments' unemployment claims and unemployment insurance payments. Unemployment insurance payments are important because that's another head count. I mean, basically, we're asking businesses, who did you pay? And there are checks on that. So I'm not expecting that this number will be revised down.
Peter, the number we got on Friday has really only added to the speculation of how aggressively the Fed's likely to move, especially in the face of rising inflation. And we heard the president on Friday really tout the growth that he has seen or the country has seen in the economy under his watch. I wonder if you think these predictions, these forecasts hold anywhere from 5 to 7 rate hikes, whether that type of growth can really continue in the face of such aggressive moves from the Fed?
We are not going to have the growth in 2022 we had in 2021, simply because we were rebounding from a recession caused by COVID. We were reopening and so forth. We all expected, even before Omicron came along, that this year would be a good year, but not as good as last year. And we wouldn't return to a normal pattern of growth of about 2% a year until the second half of 2023 or 24. There's a couple of things weighing on the Fed right now. One is that Mr. Powell, when he was concerned about being reappointed, seemed to cling to the idea that inflation was temporary much longer than he should. And there were folks both on the right. I'm a conservative economist. I write a weekly column in the Washington Times and on Dow Jones Market Watch, one of your competitors. And last February, I was saying, this guy's cooking up inflation because he's printing too much money. The Biden stimulus came along. He basically financed $2 trillion of stimulus with printed money. And on the left, Harry Summers was writing in the New York Times basically the same stuff. They're basically creating much more demand than the economy can supply as it comes out of this pandemic. And below, we got all this inflation. So now this is a man that really is in trouble in terms of his legacy and reputation. Mr. Biden doesn't fire anybody. He reappoints everyone, it seems. So he's not worried about anything like that. But his legacy is at stake. Now, he's been very tepid about raising interest rates. I mean, he's still printing money. He's saying, well, I'll start raising interest rates maybe in March. This is going to push him to raise them a bit more rapidly than he would like to, but it probably won't be enough. History has taught us that when we get inflation like 7% a year, it's hard to avoid raising interest rates a lot and bearing a recession. And I don't think Powell will want to do that. And that's very unfortunate because that's how William Miller in the late 70s handed Paul Volcker a mess around 1979.
Yeah, and there's some comparisons being discussed here. We're going to be watching that one closely. Peter Morici, economist and University of Maryland professor of business. Good to talk to you today.